All right, guys, I'm back. Let's talk about some adjusting entries, the adjusting entry concept. As I touched on earlier, I gave you a little example of an adjusting entry, which is related to accruals. And there are also adjusting entries related to the furrows. So let's recap real quick. From an accruals perspective, we're talking about things that relate to expenses and revenue. So look at both of these in terms of like what's impacting revenue, what's impacting expenses. Okay, for both these categories, kind of keep that in your back of your head. So from accrual basis, an adjusted entry can take shape when you've incurred an expense, okay, but you have not paid for it. An accrued revenue adjusted entry is when you earn the revenue for services, an obligation that you performed on, but you did not record it or you did not receive the cash. So, okay, immediately if you didn't record it, you got to book the entry, which means receivable and revenue. If, again, you didn't get cash, it's the same thing. So listen to that when you do your homework because they'll say, oh, we forgot to record an entry. Oh, now you got to record it. Oh, but you didn't get the cash until next month. So you make sure you put it in the books. Now, deferrals, kind of listen to this. A deferral is kind of like, it's like putting things off, right? So from a revenue hit and expense hit. But let's talk about those things that maybe affect expenses, right? Prepaids. Okay, prepaids are things that you pay way before you even use or consume that particular item, right? That could be like insurance. Okay, you have an insurance policy, you pay on January 1st, but it's for the whole 12-month period. 12 months hasn't passed yet. That's why it's prepaid. You paid for it, earlier. So, but you're going to be exhausting it. You're going to be expensing it over time as you consume it. But it's a prepaid right now because you didn't exhaust it yet. So an entry will need to take place every month to consume that cost, to write that cost down from the prepaids to the P&L. And we'll do an entry in that later. So remember that. Another deferral, again, is related to like an unearned revenue now. We're on the revenue side. The prepaids, you'll be consuming that to the expense account. The unearned revenue, you would be now impacting the revenue account. And unearned revenue is when cash is received before service is performed. Okay, you didn't pay the service. You know what, guy? I want you to go ahead and I want you to go mow my lawn at the office, for the next 3 months. And so I'm the lawn guy. I get the money, my company, for 3 months of lawn service. I haven't done anything yet. He just gave me 3 months of payment. Okay. Have I done a service? Have not. It's unearned. Unearned revenue. That's an example of an unearned revenue. So an unearned revenue is kind of like I have an obligation to owe this guy. So think about it. It's a liability, right? So you owe that. So you got to do an entry that reflects the liability situation. You haven't gotten the revenue yet. You haven't earned that revenue yet. So you have to reflect a liability. That would be a debit to cash and a credit to an unearned liability. And as you do the service for the company, as I have my company would mow the lawn, I would then reduce the unearned liability each month that I perform the obligation. So unearned revenue is revenue that you have not earned yet because you have not performed the service. Okay. And prepaid expense is expense that you pay in advance before you consume that expense. So you need to remember this. And you remember accruals. These are where your entries are going to come from your adjustments. Okay. So keep that in mind. So now what I'm going to do, I want to do some entries in the next video to kind of now get you started on making those adjustment entries. Stay tuned.